using a solo 401k. Solo 401k is a freaking awesome strategy for anyone self-employed where you can put money in up to 69 grand a year. You can roll over money. And yes, you can self-direct it too. It's very powerful. Great retirement plan for self-employed people. So this is like a brand new federal law. Yes, the Republicans and Democrats and the House, Senate, and White House actually agreed to something. It was called Secure 2.0, big retirement account legislation. One of the cool things in Secure 2.0 is they said, hey, if you want, you can make employer Roth contributions. Welcome everyone to the Directed IRA webinar and a special Directed IRA podcast episode. We are talking about solo 401k contributions. Many of you may have set up a solo 401k for 2023 this past year and you're thinking about how do I do my contributions? Did I do them right? How do I report them on my taxes? What do I tell my accountant or CPA? How do I maximize contributions? Maybe I'm looking to make a new solo 401k and set up. Maybe I got to roll over 401k dollars. We're going to hit all of that so you know how to do it right. I've got a lot of detail for today. I have tax code forms, boxes to check, codes to put in them. I got a lot of detail today we want to deliver. So this is for you. Guys, this is for you. We want to make sure we're giving you comprehensive educational information so you really know how to take control of your retirement account using a solo 401k. Solo 401k is a freaking awesome strategy for anyone self-employed where you can put money in up to 69 grand a year. You can roll over money. And yes, you can self-direct it too. It's very powerful. Great retirement plan for self-employed people. So before we get into it too far though, I got Aaron Haldermann here, our COO, the Great and Powerful. And do you want to give some housekeeping or some instructions here for everybody?
Well, today's going to be great, and it will be recorded. We will have the slides and all that stuff up, so hang tight with this. If you have any questions, please put those in the Q&A box. Don't chat them to us. That way we can see them, monitor it over there. So again, put your questions in the Q&A. We'll go throughout, answering them throughout this episode, and then we'll have kind of rapid fire round at the end. And if we don't get to them, you don't need to copy and paste for us to get to it. We'll get to as many as we can. And if we don't, you can always call our office. We'll be happy to talk to you. So that's what we'll do for this round. Of course, if you need help with any IRA questions, you're interested in setting up a solo K, just go over to our website at directedira.com. You can go to the appointments page, book an appointment there. It's totally free. We'll spend a good 15, 20 minutes talking about what you have going on. And if you do want to set up a solo K plan, which we'll get into throughout this episode, we'll help facilitate that with Matt and Mark's law firm over at KKOS Lawyers. So that'll be awesome. We do have two events. So let me give you the websites real quick. SDIRAsummit.com. It's our Self-Directed IRA Summit. Matt's been, how many years have you been hosting this now? Is it like 11 years now? Is it going on 11 or 12?
Maybe, I don't know.
Somewhere around there. It's been a decade.
You're
a
aging
decade
me.
plus.
I don't know.
Oh, you're not old. So a decade plus. This year is great though. We're going to Dallas, Texas. It'll be April 19 and 20. Again, SDIRAsummit.com. There's some early bird pricing up there. We have a couple options. It's going to be an awesome event, all on self-directed strategies. We'll get into some advanced stuff too. Tons of good networking. If you go live, which we always recommend, but if you just need to chillax at home, chillax, I got that from my teenage daughters, I guess. Then you can do the virtual option, which is totally cool too. The other one we have as well coming up in October, just save the dates on that, October 24th through the 26th. We'll do a 2-day conference. It's our Alternative Asset Summit. Go to altassetsummit.com. We have the recordings from our previous one last year up that you can purchase those, but we'll be updating the site. You can purchase tickets in advance for that. That'll be in Phoenix. Again, altassetsummit.com. That'll be a pretty large event, and we'll have a golf charity tournament on Saturday, a little 4-person scramble. So those are the things we have going on. We're excited. 2024 is going to be awesome. This is going to be a great episode. We went over IRA strategies a couple weeks ago. We always get so many questions on solo Ks. We're like, let's just do a special thing on solo Ks, and a lot of updates too and changes. So Matt's pulled some different IRS forms, some changes in the tax code. It's going to be freaking awesome.
Yeah, so there are some new rules that we're going to be hitting towards the end here on how to report Roth employer contributions. We're going to get to that. If you're like, Matt, what the hell are you talking about? I'm going to get to that. For the many of you that are experienced, you're like, how can you do that? I'm going to get to that because it's a new rule that is pretty awesome to do more Roth dollars. But I want to make one more introductory point before we get into the detail of how you make the contributions, how do you calculate it, how do you report it. That important point is you can still set up a solo 401k and make 2023 contributions, okay? If you're like, man, I'm getting clobbered on my taxes this year, I'm self-employed, or I got a side hustle, a main hustle, I don't have any employees, you can still do a solo 401k. You can roll money over from an old employer 401k or even an IRA, a traditional IRA, into the solo K. You could make new contributions in, which could be tax deductible if you want to do traditional and take tax deductions, or you could do Roth and build for tax-free. But I just want to say, you can still do a 2023 plan. Now, the only thing you can't do is employee contributions in an S Corp. The deadline for that is passed now for 2023. You would have to have it on your W-2, which is actually due today. I mean, I guess you could run and try and get it done today, but it's not going to happen. At least not with us. We got 50 minutes here of time. So, but we've been preaching that for months. So hopefully you were on it. But if not, and you're new to this, and you're still like, I want to get contributions for 2023, there's still time. Get a consult. Work with our team. We can help walk you through that. All right. Excuse me. Now let me talk about what we're going to talk about today. Here's the agenda. Okay, we're going to go over 2023 contribution rules and amounts. We're going to go over 2024 contribution rules and amounts. We're going to go over employee contributions and employer contributions, and we're going to go over the new law. Now I'm going to get into tax forms, how you report it, process, and all that as we go through it, how you calculate this. I've already got a bunch of questions. People have already submitted. Aaron's going to be grabbing questions as we go. But let me just kick it off here. And let's get into contributions. Now, there are some slides here attached. They're in the chat. They'll be up on the webinar after the recording as well. But we have some account guides that are included in the stats. There's a one-pager on that makes some distinctions between a self-directed IRA and a solo 401k. That's helpful, but I want to focus on contributions, so that's just there for to be informational.
Oh, you know what we didn't do? Attorney Matt.
I know. I feel like we don't need a disclaimer. It's in the slides. That's the Attorney Matt is the disclaimer slide.
So read slide 2.
Yeah. I just glossed over that because I didn't want to be Attorney Matt today. Freaking tired of it.
Is it the beard?
I'm tired of being Attorney Matt, you know? He's a buzzkill. So
Attorney Matt's clean shaven.
Yeah. Yeah, I'm rocking the beard. So.
It looks good. Yeah. Looks good. Any comments on Matt's beard, put it in the chat.
Yeah. If you hate it, just keep it to yourself. Yeah. All right. Employee contributions. Okay. Now for 2023, now think of a solo 401k like a 401k that you might have had at a day job if you're new to this. You put money in as the employee and you put money in as the employer. The difference in a solo K from regular 401k is you own the business, so you're putting money in both ways. It's both coming out of your pocket one way or the other. But we are categorizing some of those contributions as employee because there's rules and contribution amounts that you can hit on how you put it in as an employee. We're going to categorize another portion of the contributions as employer, which is sometimes called the match. This is the employer putting money in. Since you're such a great employee for your own business, you're going to be trying to max that out if you can. So for 2023, and because you can still contribute for 2023, right? I'm going to get into the deadline here in just a second, but you can still make 2023 contributions. $22,500 employee, $43,500 employer for a total of $66,000 for 2023. Now, the deadline on contributions for employee and employer differ a little bit. I'll get into that here in a second. 2024, though, you're able to put more in. So I'm just talking amounts here, just so you know how much can I put in. $23,000 for 2024 as an employee, $46,000 as employer for a total of $69,000. So all in, I could do $66,000 for 2023, $69,000 for 2024. That is 10 times as much as you could put in an IRA. So when you're talking about self-employed people, a lot of self-employed clients are like, hey, I've been self-employed my whole life. I didn't have a company with a 401k that helped withhold some of my money and put a match in for me. It's all been on me. So you might have some catch-up to do here. And the solo 401k gives you that ability to do 10 times as much as you can do with an IRA. So those are the numbers, 66,000, 69,000. Now, let's talk about employee first. And I want to talk about totally separate from employer. The rules, the calculation, the deadlines differ a little bit. So let's just talk about employee on its own. And you can see in the diagram there, if you go to the slides, I've got right there, you've got the company. So a company creates a 401k plan. You don't create a 401k plan. Your company creates a 401k plan. I don't care if your company is Dunder Mifflin. I don't care if your company is Dwight's Beet Juice.
Great company.
Whatever, a great company, But so whatever your business is, S Corp, LLC, sole proprietorship, that is the business that adopts the 401k for the benefit of its employees, which just happens to be you. Maybe it's a spouse too that works in the business or a partner. You can still do that and have a solo K. So, but the company adopts the plan. Now, you put the money in as the employee on the employee contribution part. A lot of our self-employed clients in our law firm and typically self-employed business owners everywhere should be an S corporation. Okay, an S corporation is the best entity if you're making more than 40 or 50K a year, self-employed. You should have an S corporation. It'll save you taxes. And in the S corp structure, what happens is you issue yourself a W-2. The W-2 you issue yourself, as long as you made $22,500 on the W-2, you can put in $22,500 as a employee contribution into the solo K. Let's say you made 10 grand on your W-2. Or this could even be self-employment income on Schedule C. That's what you use to determine if you're a sole proprietor. If you made 10 grand, well, you can put in $10,000 as an employee contribution. So your contribution amount is governed by the size of your W-2 if you're an S Corp, or on self-employment income if you're a sole proprietor. Now, if you're like, well, I made 100K on my W-2. Cool. You can put in $22,500 as an employee. So it's dollar for dollar up to a max of $22,500 for 2023. Remember, it's $23,000 total for 2024. All right. Now, that's easy enough, right? The math there is pretty simple, not rocket science. But this is on your W-2. So right now, you should have had your W-2 done or already talked to your accountant about this. If you haven't, you got to go back and fix some of this stuff. But if you made a solo K contribution and you're an S Corp for 2022, what you're going to do is that's going to be in, let's see, I got the boxes here for traditional. That's going to be code D. This is in box 12, excuse me. And then you don't include it in box 1 income. So if you put in, let's say you made 100K and that was your W-2 and you did 20,000 traditional contribution. You reduce box 1 income 20 grand to 80. You get a deduction for that, right? So you're not paying tax on that because you did traditional. And then it gets coded in box 12 and so this code D if it's traditional. If you did Roth, let's say you made 100K, 20,000 you put in Roth contribution as an employee, that doesn't reduce the box 1 on your W-2. It's still 100K because you don't get a tax deduction when you do Roth contributions. And then again, it's box 12, but now the code is AA. You get AA.
AA
You
Ron?
like that one probably?
AA Ron?
Yeah.
That was my license plate.
Yeah.
It gave me all sorts of grief on the road.
So, all right. So I told you I was going to get a little nerdy with the tax forms and codes, but that's how it works. There's the reference points on the slides, of course. And then can you fix that slide, Tristan? I had 10,000 on the last one that I jacked up at the bottom.
It's always good to have, too, this as a reference point. So when you meet with your CPA or your tax advisor, you have some of this information. They should already be familiar with it. But if not, then you can help give them some guidance.
Yeah, and I know some of you crank this out on TurboTax on your own.
Yeah.
So I'm just giving you some pointers so you don't jack it up or help your accountant along on the way.
You got those limits, but you also have to remember it's that percentage too. So once you hit that percentage, 25% on the W-2, 20% on the sole prop, you're still only maxing out though at those numbers accordingly.
Yeah.
So
and we'll hit employer here in a second and how that math totals out to the 66,000 or 69 total, which is your caps. But on employee, I want to talk about one other thing because we get this question a little bit and there's not a lot of guidance on it. There's not like specific guidance, but there's kind of been some suggestions from the IRS on how to do this.
Strong suggestions.
Yeah, and other CPAs and tax lawyers on how to do this. But if you're doing the mega backdoor Roth, Some of you have heard that strategy. If you haven't heard that yet, I don't got time to get into it today. We've got separate podcasts, and we should probably do a webinar on that, the mega backdoor Roth. But that's where you're like, all right, I want to do the full 66,000 of Roth, and I don't want to. It's a whole strategy. You can do it, but just say you're doing this, you know what I'm talking about. Mega backdoor Roth. It's an after-tax employee contribution. Now, your first $22,500 gets reported just like a regular Roth contribution. That box 12, code AA. The $43,500 difference to get you to the $66,000. Again, this is only if you're doing the mega backdoor Roth. Goes in box 14. Okay, it's the other box, and you would reference in their after-tax employee contribution. So, a little reference point there. Again, just nerding out here with you. Hopefully, there might be one of you that appreciates that little tip there. But all right, now we've got the employee contribution in, and let's run with the example of you made $50K actually. Okay, let's say you had a W-2 for $50,000 in your S corporation. Now we know for 2023 you could have put in $22,500. Now, how much can I put in as an employer? Now, if we go to the next slide, we look at employer contributions. Employer contributions are 25%. If you could show the next slide, Tristan. Employer contributions are 25%. Hit the next one. There you go. 25% of whatever your W-2 is in an S corp. So if I had that $50,000 W-2, 25% of $50,000 is $12,500. So I can put in $12,500 as an employer contribution. Now, employer contributions, you can have Roth contributions, or you can do traditional employer contributions. You can pick, and this is new, the Roth one I'm going to get into the rule on how you do Roth employer contributions, because there's like guidance within the last 30 days on how the heck you do this that we're going to go over. But you get to pick whether to do Roth or traditional. So I had that $50,000 W-2, 22,500 employee, 12,500 employer, because that was 25% of the 50. I've got 35,000 I put in, right? Mm-hmm. Yeah, that totals 35,000 off of a $50,000 W-2. So that's a lot of money you're going to be able to put away. Yeah,
it's amazing.
Yeah, and again, you don't have to max it out. I'm just saying, if you want to max it out, that's how much you could put in. You had 100K, all right, you could have done the full 22.5 plus 25% of 100K. You know, what is that? That's 25, that's 47,500, all right? If you want to max the 66,000 with the regular contribution rules there, your W-2 is going to be around 160 grand or 170 grand. Might be a little more than that, but somewhere in that range, between 150 and 200. Okay, now let's say you were a sole proprietor though. Let's say you're a sole proprietor, and on Schedule C, your net income on Schedule C is what you fill out if you're self-employed, you don't have an entity, or maybe you're a single member LLC, your income's going on to Schedule C, you made $50K net income. All right, well, you can do $22,500 because you made $22,500, plus you can do 20% of the net income, which is $50,000. So I could put in another $10K. So if I made $50K in a sole proprietorship, I could put in $32,500. That's the 22.5 plus the 20% of 50, which is 10. Totals 32.5. So, all right, so that's employer contribution. Now, the deadline for employee contributions and employer contributions is your tax return deadline. The only twist on that is employee contributions with an S corp, you have to put those on your W-2, and your W-2 is due on January 31st. So you get a little curveball with the W-2 rule, because really for you, with those of you with an S corp or even a C corp, if any of you have one doing this, that needs to be on your W-2 by January 31st. Now, you don't have to put the money in. The money doesn't need to be funded till the tax return deadline, but it must be on the W-2 that should have been filed by now, or is getting filed by today.
Yes.
Okay. I don't know if you have any questions on points so far. I've got one that I thought would be helpful.
Yeah, hit on that.
Okay.
I will say this too. This is a great strategy. A lot of self-directed investments, the reason the solo K is so awesome is because you can get so much more money into it to be able to self-direct. You know, if you're not doing a solo K, then you're limited to 6,500 last year, 7,000 new contributions for 2024. But a lot of investments, especially if you're doing real estate, they're 6 figures plus. Yeah. If you're doing like subscriptions, syndications, maybe some private lending, it's still like 50, 25K, 50K, 100K. So that's why this is so cool. It's like, boom, you can like get this going
Yeah.
now and start self-directing.
Yeah.
That's why it's awesome.
Yeah. And remember, like, I would say this, I mean, self-directed IRAs, IRA accounts, we have a lot more self-directed IRAs than we do solo 401ks because it's more common. A lot of people already have a bunch of money set aside in an old employer 401k, or they've got a TD Ameritrade broker-dealer IRA, and they're like, well, I just want to self-direct. All right, everyone can do a self-directed IRA because self-employed, doesn't matter. You have employees, you don't, doesn't matter. The solo K is this little niche strategy for self-employed people with no employees, okay? But that could be a side hustle, main hustle, but you just have to be a self-employed business owner with no employees. And so, but if you're in that lane, many of you are, there's more and more people out there in the gig economy that are, or that have a side hustle, like Snides here. Snides, I got the name right. I was like, did I skip on? That's what it is, I'm pretty sure.
Yeah.
So I'm gonna read his or her question here in a second. All right, so pretty sure it's him. So he says, hi, Matt. I'm a retired military pilot and retired engineer. I was just offered a part-time job assisting a military flying buddy regarding flight services. He says, I work about 2 weeks a month and make about $5K a month. Cool. He says, they're paying me on a 1099 to my LLC. I was going to set up a solo K and roll as much as I can of existing retirement account dollars and into my solo K. And he would do this under his LLC. He says, my boss. He says, have I missed anything? I really can't make too much over my retirement income because he doesn't want to have Medicare penalties. I have a self-directed Roth and 401k with you guys already. Thanks for what you do. All right. Awesome question. So this is a yes. So let me just say yes. This is a great strategy and example of what you could do. Snides could set up a solo 401k, roll over old retirement account dollars into the solo 401k. You could make new contributions or not. You know, some people, he's kind of semi-retired here, still working, so he's got self-employment income to justify his business, his LLC. Doesn't have employees, it's just him. So we can set up the S Corp and then roll over dollars and make new contributions if you want. Besides, you know, you don't have to, but you could make new contributions. So that's a good example of just using the solo K as a self-directed investment vehicle by rolling over dollars.
I hope y'all were listening to that because that was like a handful of questions that everybody was hitting on. If you have a full-time job plus a side hustle, yes, you can still do a solo K as long as you don't have full-time employees in that and it's just you or a spouse or just you. It's totally cool. And you can also roll over existing funds into that solo K. So just doing a quick recap, if you like tuned out for a hot second, that's like what we just went over on that question. We had at least 5 other people asking that.
Yeah.
So it's awesome. A lot of people do. It's a great strategy. You get going now.
Yeah. And just so you guys know, that one of our goals in doing this today is to hit a lot of your questions. So I'm going to get through the material here, and we want to hit your questions. So please get them in the are you doing it in the chat or the Q&A? Sorry.
Just the Q&A. So put those over. That way people can see what we respond to, and then we're able to send that at the end. If you put it in the chat, it doesn't have that ability. So if you're putting stuff in the chat, please just copy it over in the Q&A so I can see that.
Okay, let me hit David's question here, and then I'll get to the new rule on employer Roth contributions. Super exciting. I'll save that, make you wait for it.
That is a hot strategy.
Yeah. Okay, David asked, says, hi, Matt, Happy New Year. Thanks for all the videos and great content you guys put out, as well as those with Mark. Great team you guys have. I have a question regarding the rollover of Roth funds from the solo 401k to a Roth IRA. Are there any advantages to rolling over Roth funds from a solo 401k into a Roth IRA? Do IRA rules allow easier or earlier access to the funds before 59 and a half? Hopefully to avoid filing a 5500 EZ. Is there a difference between rolling after-tax contributions into the Roth account of the solo 401k versus withdrawing them from the Roth IRA, i.e. mega backdoor Roth? I may be confusing two concepts. Thanks so much. Look forward to the webinar. Okay, David, great questions. There's a lot in this. So if some of that went over your head, hang on. Don't worry. We'll get to it. All right, let's address the first question. Yes, you could roll Roth 401k money out to a Roth IRA, but I wouldn't do it. I don't know why you would want to do that. I don't see any benefit to doing that. If you have a self-directed Roth solo 401k account, I just keep self-directing that. You don't need to roll to a Roth IRA. Now, if you're like, well, but I'm going to wind down that business, I'm not working in it, so I need to close out the plan. Okay, cool. That makes sense. But if you otherwise have the solo 401k and you're using it, I would keep using it. Now, I see one point being raised is, well, a solo 401k has to file a Form 5500EZ. Mm-hmm. A Form 5500EZ, this is a tax form the solo K has to file. If you have a custodial account with Directed, we file this for you. If you don't, you're on your own or your account needs to do this. But when we do your solo K at Directed, we will file this 5500EZ. Now, you are not required to file the 5500EZ for a solo K unless you have 250K of assets in the 401k or greater. If you just set it up your first year, you're not going to have 250K in there unless you do an amazing investment in year one. So, you might have to worry about this for the first 5 or 6 years, depending on how much you're contributing into the solo 401k. So anytime you're under 250, this is market value as of December 31st at the end of the year. You look at your solo 401k, so was it worth 250K or more? This is adding all accounts in, your Roth account, your traditional account in there, your spouse's account, if you have a spouse in there with you, all accounts total, if those go over 250K, it has to file this 5500EZ. Now, there's no tax due on the 5500EZ. It's not like you owe tax, you got to send money to the IRS. You just have to file this informational form to them, and if you don't, there's massive penalties. But again, if you're under the 250, you're exempt from having to file it in the first place. So, David, let's say you were over the 250K in the solo K, and you're like, well, I got to file the 5500EZ. If I roll it out to an IRA and try to get below 250, then I could. I just don't think that makes sense. Also, you can't really just roll money out of a 401k to your own IRA. Just because it's a solo K doesn't mean you can just roll whatever money out you want whenever you want. You have to still meet qualifying rules. Was this invested employer contributions? Were you at retirement plan age? Did you shut the plan down? Do you no longer work for this company you set up? Like, you still have to have a reason to be able to roll the money out. You don't just get to put money in a solo K and roll it out to an IRA whenever the heck you want. So, all right. Now that's the first half of David's questions.
Part 2.
Guys, I hope you're hanging in there with me on this. As a tax lawyer, I build by the hour, trying to explain this to people, and I learned how to be verbose about it. I'm joking. But I like giving a comprehensive answer, okay? That's just my style. I want to give you all the info. All right. Now, after-tax contributions, you said, is there a difference between rolling after-tax contributions to the Roth account of the solo K? Yes, there is, actually. So if you're doing the mega backdoor Roth strategy, generally, why this is getting confused is you could be doing the mega backdoor Roth strategy at, say, your corporate America day job, where you're putting in all the employee contributions you can, your company throws in some match, and maybe you're up to 30K, and you're like, man, I could still get up to 66,000. I got another 36 grand I could put in this 401K. But it's your day job, and they're not going to let you put up to 66K, but you could put what's called after-tax contributions into most 401K plans, even in corporate America, and those dollars can get immediately rolled out to a Roth IRA. You don't get a tax deduction on them, but they immediately become Roth IRA dollars. That's the mega backdoor Roth. So that's a different strategy, and after-tax dollars can get rolled out in a 401k, whether it's solo or, again, at your corporate America day job. So little honors level question there, but great questions, David.
Oh, the 5500 EZ, this is from Sunita. If you have the 250K just in the solo 401k, is that across all your retirement accounts, or is it just for the solo 401k?
Yeah, just for the solo 401k. So if you've got a traditional IRA with 100K and a solo K with 200,000 in it, no 5500 needed. We don't need to add up your IRA or separate accounts outside the solo K.
Cool.
All right.
The deadline. Yeah, the deadline for the 5500.
Oh, the deadline for the 5500 EZ. Ooh, someone help me out there. Someone in the chat, someone from the team. I believe it's July. It's kind of a weird one. It's not the regular dates. And by the way, yes, someone in the team knows. July 31st. All right, thank you. Okay. I knew I was close. All right. All right, July 31st. Okay, let me hit, and let's show the slide on the new employer Roth rules. All right, so this is pretty exciting. I stumbled into this just recently. Officially released on January 8th. This is IRS Bulletin 2024-2. And this is guidance from the IRS on how you make a employer Roth contribution. So for you retirement account nerds, you know there was something called Secure 2.0 that was signed into law in December of 2022. So this is like a brand new federal law. Yes, the Republicans and Democrats and the House, Senate, and White House actually agreed to something. It was called Secure 2.0, big retirement account legislation. One of the cool things in Secure 2.0 is they said, hey, if you want, you can make employer Roth contributions. Prior to this law being enacted, the only way you could make Roth contributions to a 401k, whether this is, again, corporate America, day job 401k, or this is your own solo 401k in your own business. The only way you could make Roth contributions was employee contributions. Mm-hmm. Now, under this new law, they've changed the rules and say, you know what? If you want to do employer Roth dollars, you can. We'll let you do employer Roth contributions. Now, if you think about how contributions are reported, and you just, anybody's had a 401k, whether this is your solo again or your day job, right? You make contributions as an employee, and that goes on your W-2. Mm-hmm. Now, if you do Roth contributions, again, I gave the example earlier. Let's say your W-2 is $100,000 and you put $20,000 in Roth contributions. Well, your W-2 still says $100,000, right? Mm-hmm. So it didn't save you taxes. Remember, Roth contributions you don't get a tax deduction for, but they grow and come out totally tax-free at retirement. That's why people love Roth, because they think that account's going to grow and be a larger amount, and it comes back to you tax-free as you pull the money out of retirement. Versus the traditional where you get the tax deduction to put it in, which you love now because you're saving taxes now. But then that thing grows and comes out at later retirement, and you're paying taxes on the way out as you're drawing the money out. So when you do employer contributions, the company's putting the money in. See, let's say you work at Dunder Mifflin, and let's say that you're Jim. You put your $20K in as a Roth contribution. Mm-hmm. Employee, didn't save you taxes on your W-2. Well, Dunder Mifflin's going to all right, Jim, we're going to match that $20K and throw $5,000 in as the employer contribution. Well, Jim's not taxed on that $5,000 because the company did it as a traditional contribution. And Dunder Mifflin would have put that $5,000 into Jim's 401k. Jim's not taxed on it because it's pre-tax. It's a traditional, it's tax deductible. But Dunder Mifflin took a tax deduction and expensed that $5,000 to put it in. Now, when you are doing a solo K, if you think about it here, putting $5,000 in that example, well, do I take an expense for that? No, because you're not picking it up as income on the W-2. So everyone was like, well, how the heck is this going to work? The IRS answered this question. If you're putting Roth contributions in as an employer, and this is day job 401ks or solo Ks, the rule applies in the same way. The company still takes a deduction. You are still going to deduct that. So let's say you made $50K, you put in $22,500, Roth, great, that's on your W-2, but you didn't get a deduction, but you coded the W-2.
You did it right.
Yeah, you did it right. And then the employer contribution is going to come in $12,500. That's how much you could do there. Now, on your S corporation, you're going to expense that. Mm-hmm. You're taking a $12,500 tax deduction in your S corporation. And that's going to go on.
Oh, that was.
There's a line 17, I think, on your 1120S. That goes on your S corporation tax return.
Yeah, line 17.
Line 17. And so, but you're paying less tax, right? You got to deduct that $12,500. But it's Roth dollars. How did I get to deduct it with its Roth dollars? Here's how. You're supposed to issue yourself a 1099-R for $12,500 now. So what the IRS has basically said is, all right, since this needs to get deducted by the business, we have to have the employee pick it back up as income. Well, how the heck are they going to do that? Well, they decide they're going to have the plans issue 1099-Rs. So if you are doing employer Roth contributions, if you did in 2023, you should have been on this already. The IRS gave you a few weeks' notice about this on the guidance. Most accountants and lawyers barely got through it till now. We've already notified anybody at Directed, by the way, if you've done this. If you haven't heard from us on this and you have an account at Directed,
please reach out to us.
Please reach out to us. But in the future, what you're going to need to know is if you're making employer Roth contributions, those need to get tracked. and a 1099-R is going to need to get issued to you because you will pick this back as taxable income as the employee, and that'll go on your personal tax return. So that's the new rule. Now, let's say you're like, but Matt, I already did that for 2023 because I heard you guys talk about Roth and I could do employee Roth contributions. I put it in, I didn't do a 1099. Okay, there's a couple fix-its. One, just consider that to be traditional dollars that you put in and do a Roth conversion now, and you'll do a 1099-R for 2024 and you've converted it to Roth.
Easy enough fix.
Easy enough. Also, the IRS has already been asked questions on this. They've had to put official guidance out in the last couple of weeks, and one of the primary questions was, well, what if I did the Roth contribution? It was a 2023 Roth contribution, but I did it on January 15th of 2024 because I can still do my 2023 contributions until the tax return deadline, but don't 1099 me in 2023 because I didn't put the money in 2023. I put the money in 2024. And what the IRS said is, in that instance, even though it's a 2023 contribution made within the deadlines, but it was put in 2024, that 1099-R will be issued for 2024. Okay? So I know it might be a little confusing, particularly any of you that are new, but just know this is the new procedure. We want to get it out there on how to do this, and I think this webinar is the best place to do it. So that's the new process. But the cool thing is you can do 100% Roth in your solo 401k if you want. You don't have to do Roth conversions. But just make sure you're tracking those employer Roth contributions. We are starting to track those now at Directed, given this new guidance. And we're getting the 1099-Rs going for those that did do it and communicate that to us when you were making the contributions with a custodial Roth solo K. All right. Let's turn to the questions.
Yeah, so just to recap, I think a few of you hopped on late. So the Solo K employee contribution deadline needs to be reported on your W-2 today. Is that deadline?
Wait, today is the deadline for doing the
employee contribution.
2023 employee contribution
is today.
Yeah. Yeah, so that should be on your W-2 already. Now, if you were a sole prop, you don't have a W-2, so that's just going to go on your tax return on Schedule C, on your sole proprietor return. But for those the S corps, that should have already been communicated, already be done with your payroll company on your W-2.
Yes.
Okay. All right. Well, I want your guys' questions.
Okay, here we go. Ready?
Yeah.
All right. So let's see. You got?
Oh yeah. We'll come back to that.
Yeah, we'll come. Yeah.
Okay. All right. Well, Aaron's looking up. Let me show this slide here because we got a promotion. You know, if you want to set up an account, if you've been like, I've been wondering about this solo K stuff, book an account call right now. You can go to directedira.com, hit the schedule new account button right there. You can scan that QR code, gets to our new account. We will go over this. Does a solo K work in your situation? Maybe you want to do a self-directed IRA. We certainly want to work with you and help you and be your resource to take control of your retirement.
Okay, Matt, tell us how to move a traditional IRA funds to my solo 401k Roth bucket.
Okay, all right. That's a two-step process. So if you have traditional IRA funds and you want to get into a Roth account in your solo K, the first thing you're going to need to do is you're going to need to transfer the funds. This is actually considered a direct rollover, but you would request the funds be moved from your traditional IRA, wherever it's at. So let's say it's at TD Ameritrade and you want to send $100,000 over. All right, first you want to sell all the stock, get to cash in your TD Ameritrade account, and then you're going to request that the funds get over to a traditional solo K account. So you will need a traditional solo K account to receive the funds because these are traditional funds. You can't receive it in a Roth directly. Then you will do a Roth conversion within the 401k where you will convert that traditional account, the whole thing if you wanted, over to a Roth 401k account. So it's a two-step process because you got to roll over the funds, step one, and then step two, once the funds are here in a traditional account, then you would do a Roth conversion request and we would convert it to Roth. So what is going to happen is you're going to get two 1099s in that situation. Your prior traditional IRA custodian is going to issue a 1099, but they should code it that it went to a qualified retirement plan, so it's not taxable, no penalty. But then you get a 1099 from us if we're doing the conversion for you in your custodial traditional 401k converting to Roth. you'll get a 1099 from us for the conversion. So if it was a $100,000 conversion, you're going to get a 1099 for $100,000. That's going to go on your 1040. You're going to pay taxes on that, federal and state, if you're in a state with income tax. And so it's awesome to go to Roth because now that money's growing and going to come out tax-free, but you do have a little pain because you got to convert it over to Roth dollars. Because let's say it was $100,000 in the example I'm giving here, you got a tax deduction to put that money in, already. Like the IRS already let you pay less tax on that. So now they make you pick it back up if you want to convert over to Roth.
Love that. All right, hang with us. We'll go another 15 minutes or so and go through some good questions. I will say this, though. If we don't get to yours, don't stress out. Here's the resources we have to get a solo K, to do a self-directed IRA. Just go to directedira.com, schedule an appointment. Okay, you can go in the upper right-hand corner, schedule a new account call, or directedira.com for those of you listening /appointment, and you can schedule a call with one of our IRA account executives. We'd be happy to help. We will also facilitate then with the law firm at KKOS Lawyers to do the actual solo K plan. Okay, so that's how that'll work. If you have questions that are like more tax related that you need some tax advice or consulting on, Mark has a new Main Street Tax Pro certification. It's awesome. And other advisors, enrolled agents, CPAs have gone through that. And you can just go to markjkohler.com and check that out. That's, of course, Mark's a shareholder at Directed and Matt's partner in the law firm. But it's got this whole network that you can get and, choose your own adventure, so to speak, of people that are out there for some tax advice and help. So totally awesome. Okay, let me go here to the chat. I did have a good one that I just saw, and then we'll do rapid fire over in the Q&A. Okay, here it is. Is there an option to add my spouse as an employee? Right now it's a single owner, single employee S Corp, and I still qualify for a solo K if I add my spouse. So now we'd have 2 employees, but my second employee would be my spouse.
Yeah, that's totally cool. You can have a spouse in the business. And those in Utah, you can have all your spouses too. So that was a joke.
You're from Utah, though, so it counts.
Yeah, I always throw that joke out. Yes, your spouse doesn't count against you in a solo 401k. So whether they're an employee or not, but if they're an employee in the business, that doesn't affect you from being able to do the solo K. It's third-party employees that are going to cause an issue. So let's say you have a business partner in the S Corp with you or LLC or whatever business it is here. You can still do a solo K, but there's also any owners or spouses or other family of owners, family being spouse and kids actually, doesn't blow up the solo 401k qualification rules. Actually, it's cool because if your spouse does work in the business and you want to make 401k contributions for them to put more money in, you could be doing $66,000 for 2023 for you and $66,000 in 2023 for your spouse. So you could be doing a total of, $126,000 total into the 401k in 1 year. Now you would have an account and your spouse would have separate accounts, right? You have separate accounts under the one plan. So actually doesn't cause problems. It gives you options to put more money in.
A round of applause for Matt Sorensen's math today. I'm impressed.
Yeah.
You were on point. That's impressive.
I'm going for it. Sometimes I'm a little gun shy and I totally mess it up. So if I'm blowing it,
That'll do a money ball for those of you who watch that. It's a Moneyball reference. Brad Pitt, Jonah Hill. Great scene there. Okay, so David asked, how often can you do an IRA to solo 401k conversion?
So, you could do that every day of the year if you want it. There's no restriction on that. So I, don't do that. Just keep it simple. But you could do that as much as you want. Now, sometimes people will move their IRA over to the solo K and convert it to Roth. And they're like, well, I don't want to send everything because I don't want to convert everything. I'll get taxed of it all at once. I'd like to break it up in different tax years. So you can do that and kind of chunk it over if you want. But as far as rules go, you can do it as much as you want. But if you want to be strategic about it and try to keep yourself in a lower tax bracket and be like, well, I got $300K in my traditional IRA. I'd want it to be $300K in my Roth solo 401k account. Option one would be just roll the whole thing to your traditional solo K and only convert 100 of it this year. then convert the other 100 next year and the next 100 the next year. So, but it would all still be in the solo K. You just be in a traditional solo K account and a Roth solo K account. Sometimes you just want to convert the whole damn thing and get it over with, and trying to get 100% Roth dollars invested. So now you're growing 100% Roth dollars tax-free. There's not a right or wrong way to do it, but those are the issues to think about if you're trying to be strategic about it.
I'm going to go to the top for you early birds that got your questions early first. I think that's fair. I had a W-2 employee for January and February, and in March, she's going 1099 contractor part-time. So I'm assuming the question is, do I qualify for a solo K now?
Heck yes, you do.
Can I do that?
Heck yes, you do.
Yeah.
Sorry, I'm doing all the frickin' in the mix here. I'm trying to keep this PG. You can listen to this in the car with your kids, So it's only full-time employees that have worked for you for a year or longer, or part-time employees for up to 2 to 3 years. There's a tricky window on how that works. So if you haven't had a full-time employee with you for over a year, don't even worry about it. That example, they've been with you a few months and now they're 1099. They're not an employee anymore. They're an independent contractor. Solo K still works.
Yeah.
You're good.
So some of the questions are kind of a repeat, if you will. It's, how much money do I have to make in my sole prop or my S corp to qualify to max out at the 66K for the contributions and stuff. Remember, it's a percentage based, right?
Yeah, and we have calculators. If you go to directedira.com and go to the Solo 401k page, we have the calculators right there.
Yeah.
And you could run the numbers.
They're awesome. We pay a third party that is a calculator company to do that. So they're always up to date.
Yeah, whether you're an S corp or a sole proprietorship or a partnership, it'll calculate it in either method for you.
Ooh, I don't know. Okay. Advantages of solo K compared to simple.
Okay.
Yeah.
James
we can hit
asks,
on that.
Yeah. What are the advantages of a solo K compared to a simple IRA? Let me just say, if you can qualify for a solo K, I would definitely do a solo 401k.
Yeah.
If you're a self-employed business owner with no employees, you would be crazy to do a simple IRA. You can't even put more than 20 grand into that thing. In a solo 401k, again, you can put $66,000 a year in for 2023, $69,000 for 2024. So I can put way more money in to the retirement account. The cap is much higher. So that's why I would love the solo K. Now, the simple IRA could be a good strategy if you're like, Matt, I've got employees though. Maybe I'm a small business owner with 4 or 5 employees, and I'm just trying to put away $10K a year. I'm not trying to put in $20, $50K a year. I'm just trying to get $10K a year, and that's what works for me and my budget and how I want to build this thing. And I've got employees too. Cool. Simple IRA is perfect for you because you can get in your $10K a year and you can have an IRA plan for your employees. So there is a place for the simple IRAs. Also, starting this year, you can do Roth simple IRA accounts. That's another new rule. We didn't get into it yet.
We'll hit on that shortly.
Yeah, we'll get to that eventually. It's just not too hot on our list, but
and the SEP Roth.
Yeah, and you can do SEP Roth contributions too. But because we are more solo K fans, because you can put more money into it on less income, we just think the solo K gives you more bang for your buck. Plus, it's a better self-directed account to do. But you could do SEP accounts. You could do a SEP Roth account now. We're creating new account forms for that. Then we're working on even the simple accounts, especially now because you could do Roth. So, but even with the Roth component in the simple IRAs, I still like the solo K if you can qualify, because you can put 3 times as much money into it every year than you can the simple.
Well, let's hit on a couple of these real quick, and then I'll pop back up to the top. These are repeat ones too. Can my children under the age of 18 be employees of my solo K? And can they contribute to their own accounts? Any disqualifications or limits, or can I even do that?
Yes, you can do that. So for family members that will include spouse and kids, you could do accounts for them within the solo K and our plan document. So the law firm has a IRS pre-approved solo 401k plan document, allows you to adopt accounts for kids that work in the business. All right. Now they're going to have earned income in the business, right? And you got to have some method of how you're paying them. And there's different methods of doing this. But if you're an S corp, they can't be an employee in it because you're typically not paying them through the S corp. So you got to be careful about that. That's why I would recommend working with one of the tax lawyers when you set up your solo K. The law firm sets them up anyways. It's part of the consult that's included to go through that. Because there's just paying kids as a tax strategy, and in and of itself, because you can expense it on your end and your kids can pick it up and they're below the standard deduction, so they don't even pay income tax. And so then they could drop it into a 401k. But what plan are they in? Because are they an employee of the S Corp? Well, if they are an employee of the S Corp, they should get out of W-2. There's just some stuff you got to run through there and make sure you're doing it right.
Yeah, I like that. Can I commingle my contributions with me and my spouse's contributions into one solo 401k account?
No, you cannot, Jack. Generally, any question that starts with "Can I commingle?" the answer is going to be no. You can single mingle, okay?
You can single mingle. Oh, that's pretty good.
Yeah. So was that Jack that asked that one?
Yeah.
Okay. So even though I know your spouse, you're married and your money might not be all the same, and you might have a joint checking account, but in the 401k world, you have a retirement plan for your business, but each employee individual has separate accounts. So go back to the Dunder Mifflin 401k. In the Dunder Mifflin 401k, Jan had her own 401k account. Michael Scott had his own 401k account, all right? Pam had her own 401k account. Jim had his own 401k account. Even when Pam and Jim got married in the office, they still had their own 401k account. 401k contribution rules, distribution, taxes, conversion are all individually based. So you have to maintain those accounts separately. Also, if you're doing traditional dollars and Roth dollars in the solo K, you're also going to have separate accounts. You need a separate account for the traditional and separate for the Roth. So if you're like, well, Matt, my spouse and I are both going to be in the solo K, and we're going to do traditional and Roth dollars. Great. That's a lot. And you'll have 4 accounts, okay?
Which
you
is common.
can do that. Yeah, and that's fine. I'm just saying it won't just be one account that you'll lump it all together and commingle.
Single mingle. You got to single mingle. Okay, let me pop back up to the top. I can't fund my solo 401k until next week. Can my accountant backdate my S Corp W-2 showing the $40,000 contribution I want to do on today's date, even though I won't be able to make it until next week, since January 31st W-2 date is strict?
Yeah. Okay. Edmund, usually when you use the word backdate, that gives me chills. So, no, you can't backdate it. Yeah. Backdate I don't love, but I know where you're getting at. And the answer is yes, you can, but you're just not going to backdate it. On the W-2 is just going to say what the contribution is going to be. It's not indicating that the amount has been paid because the deadline is not until the tax return deadline. So your accountant can drop that on your W-2, what you're planning to contribute, and then you just got to make it by the tax return deadline. If you don't, your accountant's going to have to go amend your W-2, which is not fun. So just tell them your accountant you're planning to do it by the tax return deadline, add it on your W-2. No backdating, nothing. You're good.
No backdating, no commingling?
Yeah.
There you go. Let's see. Christopher, can an S Corp with no employees that has a solo 401k then own a percentage of another S Corp, I'm assuming that you also own, that has full-time employees?
What is this? Can an S Corp with no employees?
Putting it solo for you. Yeah, no. So the question is, I have a solo K because I have an S Corp, no employees, solo K. I also want to then own a percentage of another S Corp that has full-time employees without putting it solo 401k instead. I don't know if that other solo K you're also, or that other S Corp you're part of, or if you're like investing, making a self-directed investment. Not real sure on that, but
let me just answer this question by saying, if you are in a situation where you're a business owner and you have employees in some business that you own 50% or more of, don't be thinking about a solo K until you talk to a tax lawyer, okay? This is very complicated area of the law. If I even tried to explain it right now, someone's going to careen off the side of the road and crash and die. Like, this is so boring and complicated. It's called the controlled group rules, and it determines when do you have to count employees in one business for another business. Basically, the point of the solo K is the IRS does not want you adopting 401k plans for yourself, business owner over here, when you have another business over here with employees and not letting them participate in any 401k plan. The rules are designed to prevent you from doing that. So if you're trying to do that, what I'm just saying is it's probably not possible. There may be a loophole. Every little fact and scenario is different. You can get with one of the tax lawyers to find that out. But there is not an easy answer to this. There's brother-sister subsidiary rules on this, parent-child subsidiary rules on this. I barely can keep them straight myself. And so some of the other tax lawyers and our KQS lawyers can help with that. Sorry, that's not an awesome answer, but it is the answer.
Nylish, if you're still on and listening or coming back to the recording, please give us a call, set up an appointment. You got a 3-part question here, all great questions, but that would take the rest of our time, literally. But I do want to get to it, so please just come and hit us up. Go to directedira.com and schedule a new account call. It'd be amazing. An S corp.
That looked like a lot of tax advice, though.
Yeah.
I think you need a tax lawyer for that.
Here, let's see.
Lawyers.
It is, but we can definitely help, on the solo case side.
Yeah.
IRA portion. As an S corp, single member, no employees, do I need to issue myself a 1099 by today for the money I've earned in my consulting business?
Okay, Michaela. All right. So as an S corp single member, okay, that's a little confusing. Maybe you're an LLC single member, taxes an S corp.
That's what I'm missing.
That's probably what you are. No employees. Okay. Do I need to issue myself a 1099? No. You don't issue yourself a 1099 if you're an S corp. You issue yourself a W-2. And then you're going to do an S corp tax return, which is an 1120S, and you're going to get a K1, which is your share of profit. So you don't issue yourself 1099s. You issue yourself a W-2. So you got to take a reasonable salary in an S corp. And that's something, again, we dropped the markjkohler.com. You go to the...
You're welcome, Mark.
The Main Street Tax Pro Network. There's a ton of accountants there that know this down pat that can help you with your S corp tax return and how you do all your reporting. Michaela, I'd definitely get over there.
Let's see. Oh, Michelle wanted us. Oh, thank you, team, for being on here. Big shout out to Jared, Matthew, Michelle. They answered a ton of questions, almost 30 questions. Thanks so much. We got a great team. Thank you, guys and gals. In a solo K, what are the advantages to the company for employer contribution versus the after-tax contributions?
Yeah.
If they all eventually, I'm wanting to go into my Roth.
Ooh, that's a good one, David. We've debated this, actually. So if you're like, at the end of the day, guys, I just want the max $66,000 for 2023, $69,000 for 2024. I just want the max of that to be Roth dollars. What's the best way to get there? I would say the mega backdoor is the fastest way to get there. Because what the mega backdoor does is, all right, let me take a step back. Some of you don't even know what the mega backdoor is, and I don't blame you if you don't. It's super confusing. I've heard it explained wrong so many times. Basically, what the mega backdoor 401k is, this is for a mega backdoor Roth 401k. What that is you're saying, hey, I want to have the full $66,000 in Roth. Cool, and I'm just doing this off of the 2023 numbers. Cool, my first $22,500, I make $22,500. That's going in as Roth. The rest of that I've got to get, the $43,500 up to $66,000, there's a couple ways you can get there. Option one, the regular method is, well, I'm just going to do these new Roth contributions I can do. 25% of my W-2 that goes in. But I think you're going to need to do, and we could do the calculator, but you're going to need to be at like 170 or 180 grand on the W-2 to get that other 43,500 that you would put in. I think if I did, this will test my math skills here on the calculator. I think I just need to do 43,500 divided by 0.25, and that'll tell me what you need. Let me see. Hang with me here.
The suspense.
174,000.
You're like on it.
We're going to be teaching math here pretty soon.
We're going to teach advanced algebra.
Okay, 174 grand. That's what you're going to need to make to max that out. So now that's option one. That would be the regular way you do it. And that would get you to $66,000 in your solo 401k. Option two, you do this after-tax mega backdoor method. Now, the mega backdoor 401k was first created for people that had a day job 401k that put in their money, their company threw in some match, and they had money left over. For example, I had these guys that were they worked on oil rigs in Alaska, and they were high income. They made a couple $100,000 a year, and they were trying to max out their 401k. They lived cheap up there. They got housing and everything covered for them. And they're like just trying to stuff money in their 401ks and max out. It was awesome. I was like, you guys are freaking cool. And so they used Fidelity, this oil and gas company. And they had the strategy down. This is where I learned it, was just running into a client, some oil worker guys, that were
cool.
smart about this, figuring it out. And I dug into it and found out actually a lot of people do this. So, but in that strategy is what you do is you make an additional after-tax contribution for the balance up to 66. So let's say you got 30K in there from your contribution and the employer match, and there's another 36 left. Well, you could drop 36 into the 401k as an after-tax employee contribution that could immediately get rolled out to a Roth IRA. Okay. And the reason you want to do that because you want to get it out of the 401k in that employer scenario, it's the after-tax dollars. You can get it right to a Roth IRA. So that's what they were doing. They do it every year. That is the mega backdoor traditional strategy. Now, if you take the mega backdoor in a solo K, you may be like, well, I don't need to roll it out. I mean, I'm cool with what I have here. It's a solo K. I can self-direct it and do what I want. So you could do the 22.5 as employee contribution, and the other 43.5 you could do as an after-tax employee contribution, which you then convert to Roth in plan, and you can leave it in the 401k. You could roll out to a Roth IRA if you wanted, but if you're doing Roth already every year in the 401k, you could just leave it there and do an in-plan conversion to Roth. Now, this is a complicated process. We have a special form at Directed for this. A lot of CPAs, accountants, and tax lawyers don't even know this. Okay, this is high-end,
this
smart
is pure
planning.
gold.
Yeah,
this is
okay.
pure gold.
So so that would be the process. Now, your W-2 would at least need to be 70 grandish, let's say, because you got to be at least 66,000. And you got some, some self-employment tax, or not self-employment tax. You got like the Medicare and all these taxes. So you got to get it netted to 66 on the W-2. So as long as your W-2 is that, you could do this mega backdoor and get 66,000 a year. 69,000 next year, or this year, 2024, into the solo K of Roth dollars. So I think option 2 would be the most strategic because it gives you a lower W-2. You can get all that money in on a smaller W-2. But option 1 is going to be the easier in terms of reporting, taxes, getting it done, just because it's the traditional way to do it. The mega backdoor is kind of, frankly, using a loophole. So you have some gymnastics you have to do in that strategy.
But totally doable.
But totally doable, and you should be working with a CPA or accountant or tax lawyer that knows that strategy down if you're doing it, particularly your first year. Just know if you're doing it Directed, we do have a specific form that is an after-tax contribution form when you're doing that after-tax contribution amount that immediately will convert it to Roth. We just want to make sure, because you don't want to hold after-tax dollars in a 401k. You immediately convert them to Roth if you're doing that.
All right, let's hit 2 more since we're at the top of the hour. And then if we didn't get to your questions, again, and it's not like all bunch of tax questions that you would need to talk to your tax advisor about, but if it's related to the solo 401k or IRA, just go to directedira.com and schedule a new account call. There we go. Tristan threw that up there. And if you open an account with us, use that promo code webinar50. We'll hook you up with $50 off your first year fees. For all accounts. So if you're doing 4 accounts, 4 participants, you and a spouse, 50 off all of them. Happy early Christmas. Okay, Adam says, I have a SEP with you guys. Thank you, Adam. Appreciate that. Is there a benefit for me doing starting a solo K now versus loading up my SEP? I love that, loading up the SEP.
Yeah.
The SEP.
It depends on how much you're trying to contribute and what your income is, and also what you're investing in, frankly. So the difference between a SEP IRA and a solo K, you can both put $66,000 a year in for 2023, $69,000 for 2024. But how you max it out, you get faster in a solo K. So I don't know your income. It was Adam?
Yeah, Adam.
But in a solo 401k, let's just take, you made 50K. Okay, this is your S Corp. You took a $50,000 W-2. You made another $100,000 in profit. You made $150K for the year. All right, so you have a $50,000 W-2. Well, all right, how much can I put in a solo K? $22,500 for 2023 plus 25% of $50,000, $12,500. So I'm at $35,000, right? So I can put in $35,000. Now, if I made $50K on the W-2 and I'm doing a SEP, how much can I put in? 25% of the W-2, $12,500. That's it. So I can get more money in the solo K on less dollars. So depending on your income, if you're trying to max out, the solo K might give you more juice to get more money in on a lower taxable income amount. So that's benefit number 1 of the solo K, and then really the primary benefit why we like it. Number 2, when you're buying leveraged real estate with an IRA and you're self-directing, there can be a tax called UDFI. It's a chapter in my book. We have other webinars on it. Solo Ks are exempt from UDFI on leveraged real estate. So if you're buying real estate with debt, you're getting mortgages to acquire property, that's a nice benefit. Solo Ks are exempt from it. You don't even have to think about it. So there's a little distinction depending on what you're investing in. If you're like, I'm investing in a startup or I'm doing a private money note or something, and it doesn't matter. There's no difference there in terms of when you're investing. The next criteria, I think, would be this Roth criteria. SEPs, you can do SEP Roth accounts, but there are no forms out yet for that. The IRS gave some guidance, but
we'll have them shortly at some point.
The minute they're available, we will launch them and get them out to everybody, and we will start doing SEP Roth accounts. But right now, that's kind of pending. You can still do solo Roth 401k accounts. So if you want to get over to Roth and convert or start doing new Roth contributions, the solo K would have a benefit too. So those would be pros and cons. We still have a lot of SEP IRA accounts. You know, some clients just like, that's what I've used, and I'm not, what I'm trying to put in based on my income, it works, the contributions. I'm not doing anything where I care about UDFI in my investments, and you can stick with the SEP IRA. Frankly, it's cheaper and easier.
I don't want to.
That would be a benefit. Let me say that. That would be a benefit to the SEP IRA of the solo K, because the solo K is going to cost you $1,000 to set up the plan.
That's true.
If you have over $250,000 of assets, you have to do the 5500 EZ, where you don't with the SEP IRA.
A little bit more tracking.
Yeah. So, I mean, it is a little simpler, I will say.
We're not going to end on this one. We're going to do one more, but I do want to hit it because it's like a true retirement one. And it sounds like you had a good ride there, Rob. So Rob has a solo K with us, looking to retire in the next year. Is there? I'm assuming you're done with that full-time business. For that solo K. Is there a specific process that I need to do to dissolve that solo K, and do I just start rolling over to IRAs and do a final 5,500 EZ?
Yeah,
because obviously you have more than 250K of assets. Congratulations, and you're retiring. It's awesome.
Yeah, that's a great question, Rob, and congrats. So what you will do is you would basically, once the business is winding down, you would dissolve the 401k plan and do what's called a plan termination. Now, we have a process for this at the law firm and also in closing it out at Directed. And there are kind of two things you have to do. Well, there's really three things you have to do. Option one. Step one would be move the assets out. Sorry, guys, this is late in the day here. I was like, all this math I was doing earlier.
Yeah,
okay,
really got to you.
3-step process, okay, for closing out your solo 401k. Step one is we want to move the assets out. Now, you can move them to a self-directed IRA, whether it's cash, you have real estate, private company ownership, LLCs, notes, whatever. We can just do an in-kind transfer of the assets to a self-directed IRA account. And that could be whether a traditional IRA or a Roth IRA, depending on what you have in the solo K, traditional or Roth. So we got to get the assets out, step one. Step two, we're going to do a plan termination. There's an actual document that you terminate the plan. You have to do it in writing. You don't file it anywhere, but you need to have this actual document done. And then step three, you will file a final 5,500 EZ.
Which you knew.
Now, even if you were under 250,000 of assets, you're like, but Matt, I only had 175. I was below the 250. I thought I only needed to file the 5,500 if I was if I was over 250. Yes, except in the year you terminate. The year you terminate the plan, no matter the amount, you have to file a 5,500 EZ and say the plan assets, report what happened to them. In your case, you would say, I rolled them already to an IRA, and then you terminate, and then your plan is terminated. So that would be the 3-step process. Now, it's not like you got to rush to do it. The IRS has actually set another guidance. You kind of have 3 years to wind down a plan. So if you retire this year and you kind of are keeping the solo K going for a year or two, you're not contributing, you're just working with the money in there, you're going to be fine. But then eventually by year 3, you want to close it out and transfer out the assets, file the 5,500 EZ and be done with it.
We have one more, but I'm going to hit Alan's question before we end on this last one from Sunita. Alan asks, is there any road shows for 2024? I love that. Yes, there's 2. We have 2 live events. April 19 and 20, Dallas, Texas. Go to SDIRAsummit.com. That's our annual self-directed IRA summit.
Which has a section on solo Ks.
And it'll be awesome. So go there live. If you can make it, network. It's always a good time. If you can't, you can do the virtual. Matt's been hosting it for a decade plus. The other one is our alternative asset summit, which is 2 packed days October 24th, 25th in Phoenix. You can go to altassetsummit.com, and that is, we're covering all alternative types of investments. And there's some stuff on self-directing, of course, too, but it's like what you're doing with the solo K or IRA that you're self-directing into these alternative asset investments. Okay, that'll be awesome. Altassetsummit.com, October 24, 25, 26 for that. Those are our road shows. Okay, We'll wrap it up with Sunita. Again, the presentation, the slides, that'll all be up on the website, directedira.com/webinar. We'll have that up there. I want to thank our crew, Tristan, as always. We appreciate you, buddy. He's always in the studio with us. You don't get enough love sometimes, but we appreciate it.
Tristan says he'll have it up by Friday.
There you go. Sunita, if I worked for a company and had a W-2 for part of the year and I didn't max out the 66K, I want to now do a solo K because I'm going full-time in my own gig now. It's my side hustles becoming my main hustle. Is the limit still 66K across all plans?
Okay.
We're going to end on that one.
Yeah. I feel like I've been like professor mode today and a little like technical. So forgive me if any of you are new. You're like, damn, this went over my head a little bit.
This is
a little too
good.
much.
This is like what it is.
I know. I want to know the detail of like, oh, everybody set up these solo Ks. What do I need to know?
A lot of you do
a lot of questions.
A lot of you do wrong or have done them wrong.
Yeah.
If you had or you think you have, you need to call us. We'll work with you over at the law firm. Get them fixed up. Like it's a big deal. Like, and you may have formed one yourself through like this form process all online and be like, yeah, I qualify, or maybe you didn't, or you just need to be fixed. So if you did, or you're questioning it, give us a call.
Yeah.
We'll help facilitate.
I mean, I hate to say it, we've built a reputation on being the company that knows what the heck we're doing in this space. I mean, I don't mind to toot our own horn.
We got the expert right here.
Yeah, we get a lot of the fix-its. I did this on my own, or I did it with some other company with some guy in his basement, that cranked it out on his own, and he professed to be an expert, and it's all jacked up. So we're trying to give you all this content information about the detail, because that detail matters and how you actually do.
We're not being a buzzkill. Not trying to be a buzzkill.
And remember, guys, this is the same thing next year, and the next year, and the next year. Eventually, you get the hang of it, and it's the same damn thing over, and it seems like easy. Okay, let's get back to Sunita's question, though.
Yep.
What was
right here?
All right, so if you worked for a company part of the year where you got a W-2 and you were contributing to that company 401k, and now you're self-employed and you're like, all right, I want to throw money in the solo K. The question is kind of like, can I get 66K in that company 401k and 66K in the solo 401k, or what do I have to reduce between the two? So the employee contribution, the 22.5, you cannot double dip on. No matter how many 401k plans you have, you're working 2 full-time jobs at companies, you got a day job and a side hustle with a solo K, you can't double dip on the 22.5, but you can on the 43.5. So
kind of weird.
So it conceivably you could have maxed out your day job 401k at $66,000. You probably didn't, but just hang with me here. And you could do $43,500 in your solo K. Okay, so that's how it works. You don't get a double dip on the
employee
22.5, the employee, but you can double dip technically on the employer contribution. In the example here, we had the day job and the solo K, this side hustle.
Well, we covered quite a bit, and we try to get as many questions as we can. We are just a 2-person team, and those that hop on our team to answer questions. So we do appreciate y'all tuning in. We love what we do.
Yeah, thanks everybody for tuning in. Thanks for all of the awesome questions. Make sure you're at directedira.com and you're signed up for our newsletters so you get notices of this, about our Self-Directed IRA Summit as we're going on the road. We want to see you guys. By the way, we're going to do a live podcast recording at the Self-Directed IRA Summit. That'll be pretty cool. So thanks again for everybody for being on today. Your amazing questions. Thanks to Aaron, Tristan, the team that was in the chat. We'll see you next time. Until then, stay calm, self-direct IRA.